after 11:30. Welcome to the Indiana Farm Equipment and Technology Expo from Grand Park in Westfield, Indiana. New location for this show. Thank you for being here. And if you're joining us online via YouTube or Facebook, thank you for streaming and joining us for the Keeping the Bottom Line Black discussion with the experts from Purdue's Center for Commercial Agriculture. Dr. Nathan Thompson is here, Dr. Michael Langemeier, and also Dr. Jim Mintert, who is the director of the center. And I asked you, Jim, a couple of weeks ago, can we keep the bottom line black next year? And you said, most assuredly, or something along those lines. The question is how. Obviously, a lot of things to consider, a lot of ground you would like to cover. So welcome. Thank you for being here. It's all yours.
Thanks, Andy. Appreciate the opportunity to visit with you today and also the folks that are online. And we're going to talk about a few things that are maybe relevant to the corn and soybean outlook, but that's really not going to be the focus of our discussion. We're going to spend more time talking today about marketing strategies, not only the ones that you can use in 2022, but also from a longer term perspective. And then Dr. Langemeier is going to talk quite a bit about some of his computations with respect to break-even analysis and what maybe some of those implications are with respect to acreage decisions. And then actually talk a little bit about farmland leasing, because I know that's going to be a hot topic, excuse me, not only this winter, but also as we look ahead to the 2023 crop. So I'm going to start off just talking a little bit about some of the things with respect to what's influencing the corn and soybean outlook. And so if we could maybe kick off that first slide. Key factors for both corn and soybeans are exports. And if you look at the corn export projection from USDA, they're currently projecting exports down about 250 million bushels compared to last year at about 2.5 billion bushels. If you look at the next slide, take a look at what's happened so far this year. Current marketing year commitments and sales. So this includes shipments as well as future commitments. And as you look at the numbers, we're down a little bit compared to last year at this time. And each one of those comparisons is to the same period in the prior year. So comparing to 2020, 19, 18, 17, and 16. And then as you look at the China side, our exports, combination of shipments as well as future sales that have already been committed but not yet shipped, we're actually a little bit ahead. So the export picture on corn is not too bad. And I'm going to show you the export picture on soybeans a little later, and it's a little different picture. So far, exports on the corn side look pretty good. If you look at the next big component of demand, that's ethanol. And USDA is anticipating a modest recovery in ethanol usage as the economy kind of recovers, we get back to driving more. If you look at what's taken place so far, though, in that next slide, the ethanol usage numbers actually suggest USDA's forecast might be a little too pessimistic. So just a little bit of interpretation on this slide. These are the week-by-week comparisons of ethanol production compared not to last year, not to 2020, but rather to the pre-pandemic era 2019. So I'm comparing 2021 to 2019. And of course, those red bars indicate we were running well below 2019 levels. Look at the right-hand side, and you can see that we've had some pretty good increases with respect to ethanol production compared to 2019, compared to the pre-pandemic era. The last few weeks, we've backed off a little bit, but we're still averaging above the 2019 era. So as you think about it and think about maybe whether or not you want to be optimistic or pessimistic about where corn's going, ethanol is a plus. And I think one of the previous speakers pointed that out as well. Looking ahead, when USDA makes their next round of revisions in January, it would not be surprising to see them increase the ethanol production numbers, the number of bushels going into ethanol. That would pull down the corn carryover a little bit, and that's going to be one of the key issues. If you look at the next slide, which is the estimated margins at an ethanol plant, this is based on some data from Iowa State University. Those margins have been near record high. If you look at that $1.54 per gallon, that was a few weeks ago, but even the most recent data, this slide is updated through last Friday, still over $1 a gallon. So that suggests to me that ethanol production is going to continue to be very strong this winter. The only thing that would hold that back would be a pullback in terms of the economy, right? If we start pulling back, quit driving, the economy doesn't continue to open up as it has been. And obviously, there are some concerns that could happen. But certainly, the data so far is looking very good on the ethanol side and would suggest maybe more ethanol usage of corn than what USDA is projecting, and maybe leading to a little tighter supply situation, a little tighter supply demand balance than what USDA has been projecting. So you look at that next one, yeah, corn ending stocks. USDA's current projection for the current marketing year 21, about 10.1% carryover from the 21 marketing year into the 22 marketing year. That's up from last year. If you think about a thumb rule here, I like to think about that carryover estimate being above or below 10%. And the years when that carryover gets below 10%, you can get some pretty good volatility. So if we tighten up the carryover a little bit relative to where we are now, that pulls us down below that 10% value and maybe sets us up for some modest improvement, even relative to current prices. And I know corn prices have rallied in recent weeks. I'm not going to really talk too much about this, but then the related factor, obviously, with respect to corn is what happens in South America. And you're going to be inundated every day from now until probably the end of March with respect to weather forecast for South America. All I'm going to say there is it's going to be worthwhile to pay attention, because that's going to be a big component of what drives the change in carryover, not only for the world, but obviously also for the U.S. as well. So I'm going to go from there. Oh, yeah, let's look at the world situation. So the world situation, these are the world estimates from USDA. Their last report, and last two reports, had ending stocks from a world basis at 26%. That's well below where it was back in 16, when we were at 33%. So we are tighter on a worldwide basis. And I actually think this chart probably understates a little bit how tight world supplies are. If you look at the major exporters, which is really what counts, that situation is tighter than what the world numbers would suggest. And one of the challenges with the corn ending stocks estimates on a worldwide basis is about 60% of that is in one country, China. And a big question mark in terms of what the quality of that corn is, and truthfully, even whether or not the inventory estimates are accurate. So when you look at the major exporters, that corn situation on a worldwide basis starts to look a little tighter than what this chart suggests. And again, suggests from a worldwide basis, we need to see trend line production numbers coming out of not only North America, but also South America. And any kind of a hiccup there with respect to production probably going to reduce the carryover estimate here in the U.S. and be positive for corn prices. So let's turn our attention to soybeans a little bit. So obviously, huge interest in soybean exports. USDA forecasting a decline of about 260 million bushels this year relative to last year. So they're already cognizant of the fact that soybean exports are likely to be weaker in this marketing year than last year. If you look at the next slide, which is the current marketing year situation, not only for the world situation in terms of all destinations, but also what's taking place with respect to China. Different picture than what I showed you for corn, right? Soybean exports, combination of shipments and commitments, down, I think, 27% compared to last year. China alone is running about 30% below last year. So the big wild card there is obviously exports in total, and in turn, what's going to take place with China. And I don't think any of us really have any special insight with respect to what China is going to do. I think that continues to be a source of tremendous uncertainty. So that's going to be the wild card, along with weather conditions in South America with respect to the expectations for production. So again, if you want to get optimistic about soybeans, the two things I think you have to get optimistic about would be exports. And in turn, if you're going to get optimistic about exports, that's probably going to be tied back to maybe some pullback of production in South America. So again, it's going to be watching the weather pretty carefully in South America, and also watching what's going on with China. I would not be surprised in the January report if USDA chooses to pull back their export number for the world exports from the U.S. to the rest of the world, based on what's happened so far. If you look at what's taken place so far relative to their estimate, they're not too far off, but if it continues with the weak trend that we've established so far, The concern is the big window for U.S. exports is from harvest time in the fall here in the U.S. till about the end of January, maybe sometime in February. So if we're going to see some catch up on soybean exports, it needs to take place pretty quickly, and that's going to be a challenge. So I think I'm a little bit more concerned, more friendly with respect to the corn side than I am the soybean side. If you look at the ending stocks numbers, it looks a little better than the corn side. It's 7.8% versus on corn we were at 10%. The bad part about that is, does anybody remember what that 7.8% was projected to be last summer? Yeah, at one point we had it down below 4%, right? So the trend has been going in the opposite direction or the wrong direction in terms of increasing that carryover relative to what we were expecting back in, say, June and July, especially. I heard one of the previous speakers talk about this a little bit and mentioned the fact that they were concerned about the carryover estimate, which is currently sitting at about 340 million bushels, how much of an increase USDA might show in January. And I'm kind of in that same camp, worried about whether or not we might see an increase in that carryover number on the January report. If you look at the world soybean stocks estimate, it's a little bit like corn, although there is a distinction here. You don't have the one country analogy concern with respect to a large inventory sitting in China. Again, though, as you look at those soybean carryover, 27% or so, down from that 33% when we had that big carryover, largely as a result of the pullback on world trade as we got engaged in the trade war with China. On a worldwide basis, one of the interesting things about soybeans has been the strength in soybean oil, which has really carried soybeans for quite some time. And then if you look at what's taken place recently, it's been the strength in soybean meal. And I know the previous speakers were talking a little bit about the soybean meal situation with respect to increasing demand for soybean meal because of a shortfall in lysine on a worldwide basis. That's likely to continue. So we're likely to continue to get some positive news on that front. And I look for meal to be relatively strong here going forward. So that could be an interesting situation that develops over time. So that kind of wraps things up from kind of the outlook side. If you think about from the corn side, a lot of it is going to hinge on what takes place with respect to South American production. So we're going to have to watch that very carefully, particularly the second crop corn coming out of Brazil. A lot of uncertainty with respect to acreage in the 22 crop. That came up in the last session as well. If you're going to get friendly on the corn side, probably the big friendly news is mostly on the ethanol side with respect to very strong ethanol usage, possibly pulling down those corn carryover numbers. On the soybean side, trade is a concern. The exports have been weak. If you're really going to get optimistic about soybeans, you really want to see a stronger export value. The good news is the crush is looking good, both from an oil and a meal standpoint. So of the two, maybe a little friendlier towards corn than soybeans. And then obviously we're going to have that big debate, which we'll talk about a little later with respect to what's going on with acreage. So I want to turn to Dr. Thompson here and let him talk a little bit about some of the research that he's done with respect to marketing strategies. And Nathan, I'll let you take it away.
Yeah, so talk a little bit about some marketing things. So again, you just heard a really good short run outlook, and given kind of the theme of our kind of session here on keeping the bottom line black, I wanted to think about some things that were maybe not so much related to kind of short-term marketing decisions, but more strategies that can be implemented over maybe a longer period of time. So the three things that I really want to spend my time talking about, and again, I'm going to address each of these pretty briefly, is first, right, the role of basis, thinking about where basis fits into your marketing program. I also want to talk a little bit about storage, right? Storage is a really common marketing strategy for most folks. But the question is, right, do you have a merchandising plan for the grain that you have in storage? And there's a number of reasons why that's important as it relates to the risk that we might be taking in terms of storing grain too long, but then also some different strategies that we can utilize for those bushels that we have in storage. And then I'll wrap up a little bit talking about carrying charges, right? How do those fall into that marketing program and even some pre-harvest marketing and how do we develop strategies about what we know about both carrying charges and those futures, seasonal patterns and futures? So let's start with basis, right? So obviously when we market grain, we're selling for a cash price. That cash price has two components, right? The futures component, which we can all see on our phone at the board in Chicago, and then the basis component, which is the localized component of that cash price. And so we have a lot of information on futures, a lot of tools of how we can manage futures price risk, but we often overlook basis, right? So in order to implement basis information into that marketing program, you need to be able to build some expectation of what you think basis is going to be in order to kind of make those marketing decisions. And so as we were kind of going around and teaching some marketing stuff, a big kind of hole that we saw was that folks kind of understood the role of basis, but maybe didn't have the information that they needed to implement that into the decisions that they were making. And so that prompted us to put together the Purdue Center for Commercial Ag's crop basis tool, which is available on the Center for Commercial Ag's website, which the link is on the slide there. And so that's a free tool that houses both historical basis data across crop reporting districts in Indiana, as well as Illinois, Ohio, and Michigan. And in addition to the historical data going back to the early 2000s, there's also current basis information, and they're updated every week. So you can look at what current basis levels are relative to those historical years. And again, there's a lot of different ways that you can look at the data. You can average across multiple years. You can look at individual years. So if that's not a resource that you've tapped into, I would encourage you to take a look at that because there's a lot of valuable information in there as it relates to developing kind of an expectation of what you think basis is going to be and what those trends and patterns might be in your local market area. So on the next slide, I just have a few screenshots from the tool itself to give you an idea of what you would find if you went to the tool. So here we're looking at corn basis in central Indiana. The blue line here is the historical 3-year average. So I've selected that to kind of pull that out of the tool. Again, you could look at whatever information you wanted in terms of individual years or a longer average of more years than what I have here. But the 3-year average is kind of what we default to there. And then the black line would be the current year's basis level. So starting at the beginning of the crop marketing year in September, every week I'm updating what current basis levels would be in that particular region. And so you can see we started off the year with strong basis kind of coming out of last summer. That quickly kind of reverted to the mean there, and we've really been running right along that 3-year historical average, which again, that average is our kind of best expectation of what we would expect basis to be anyway. And so we're really right on track there in terms of basis levels where we're at this year. If we look at soybeans, it's maybe a little bit different story. Again, we started off strong coming out of last summer into this crop marketing year. Again, we kind of reverted back to that average. We were maybe running a little further behind that. Here we're looking at a 2-year average on soybeans. That's kind of the thumb rule that I use for soybeans based on some research that we did. So we're running a little bit further behind that 2-year average, but you can see in the last several weeks since, say, the beginning of November, we've seen soybean basis strengthening a lot more than what we've seen on the corn side. And again, that's just catching us back up to where that historical 2-year average is. So again, be aware of basis, pay attention to basis. We have lots of resources on the center's website as it relates to how to implement basis information into a marketing plan. And then utilize the tool, right? So if you're already aware of the importance of basis, but you're struggling to kind of figure out what your expectations are, the tool is a good place to start. Again, it's not basis information for a particular location, so you wouldn't necessarily sell grain based on the information in the tool. It's a regional average, but it is a good kind of place to start in terms of figuring out what trends in basis are and what the patterns in your local region might be, so you can kind of implement that.
And Nathan, I think it's important to point out that blue line, which is the average, that's really the best forecast that we've got. So for corn, your research suggested a 3-year average was optimal.
That's right.
And soybeans, a 2-year average, maybe in some cases a 3-year average, but typically a 2-year average. So relatively short averages give you your best forecast year in and year out based on that over 30 years of data that you were looking at, right?
Yeah, so we were looking at 30 years of data, and basically, you know, more recent information tends to be more valuable on the soybean side of things. The corn side, 3 to 5 years really wasn't all that different. 3 years was the best, and so that's kind of what we default to. But yeah, in terms of kind of forecasting and looking forward, that's the thumb rules that we use when we're using the tool. So if we move forward, the next thing that I want to talk about a little bit is some storage strategies. So again, storage is a common tool that a lot of producers use when marketing grain. And one thing I want to point out before I get into the information in the chart is we did some research looking at, okay, what were the net returns to storage throughout the crop marketing year, right? And so what we found was that, and again, this wasn't novel to us, but it was important to kind of validate what had been done maybe in previous time periods was that, there is a increasing kind of net returns to storage from October through, say, the early summer months, April and May. After that point, we see those net returns to storage start to decline. And so it's important for folks that are storing grain to have an idea what they want to do in terms of merchandising that grain and not just holding on to it with the hope that we're going to get to some unknown level, right? So understanding the risk that you're facing and the time period that you're looking at in terms of making sales is really important. So the main thing I want you to think about there is, what is your strategy for getting rid of it, and being aware that the longer you're holding that grain, especially into those summer months, you're taking on a lot of risk as it relates to the returns to those bushels. With that said, I also want to talk a little bit about some different strategies as it relates to earning storage returns. So what I have on the slide here is I've picked a month, May, right? So if we're going to store grain from October, let's just say, as harvest through May, let's look at two different strategies and what the returns for those strategies might be. So the first strategy is an on-hedge strategy. So we're just putting bushels in the bin. We're not taking any position on either the basis or the future side of things, and we're going to see what happens. And so that's the dark gray bars that you see on the slide. As you can see, there's a number of years where we have relatively high returns to that strategy. And again, these are net returns. So these include storage cost and opportunity cost on those bushels. So this would be your gross return minus your storage cost. And there are years where I call them home run years, right? We can do really good. And last year was one of those years. We had a big rally in futures between harvest in May, and because of that, we had some really large returns to this speculative strategy. There's no ceiling on those returns. As much as futures can rally, we can earn returns to that strategy. The other strategy is a storage hedge strategy, and this is important as it relates to some risk. So again, you can look at the slide and see that the gray bars for the on-hedge strategy, while maybe we leave ourselves a lot of upside, we also are taking on some downside risk, right? Because futures can move in the other direction. We're not protected on those futures prices or moves. And so we can see big losses for that strategy as well. The gold bars, on the other hand, is hedge strategy. That would be a strategy. We put bushels in the bin in October. We're going to sell futures. Okay, so we're protecting ourselves on the futures side. We've eliminated the futures price risk, and now we're only speculating on basis. And research tells us that basis is much more predictable than futures. And again, I just told you, you have the crop basis tool to build an expectation of what those basis levels should be going forward. That's relatively predictable. And so you can see the gold bars show us a steady return with a lot less downside. But the upside is capped, right? Because we can't realize those large rallies in futures. We're kind of capped on that upside, just the increase in basis between October and May in this scenario. So then if you look at the averages there, so for the on-hedge strategy, this is 30 years of data. We've got an average return of 33 cents. Again, that's above storage cost. For the storage hedge scenario, right, those returns to May are 17 cents a bushel. So you're taking a little bit of a discount there because you take those peaks out. What's interesting, though, is if you take out those 4 years where I have red arrows, those home run years, that average for the on-hedge strategy drops from 33 cents a bushel down to 10 cents a bushel. Okay, so again, that's a strategy where you may want to have that as part of a marketing portfolio, right? Having some on-hedged corn in storage is not a terrible strategy, but it might want to be a smaller portion of that portfolio than some other strategies.
So, Michael, when you looked at this slide yesterday when we were getting ready for this webinar, you had an interesting take on the chart. Could you share that with us?
Yes, I think Nathan mentioned it. There's a lot of downside risk with that unhedged strategy. All those gray, look at all those gray bars that are below zero, and so certainly using that as your sole strategy would not be a good idea.
Yeah, so you've really introduced a lot more risk into your marketing
Yes.
plan by doing that, right?
That's right. So let's look at the same thing for soybeans here. And again, we get a little bit different picture. And so this is the same setup. We're just looking at storage from October through the following May. I've got an on-hedge strategy. We're not taking any position on both futures or basis, just speculating on those cash prices increasing. And then the storage hedge strategy is, again, we're going to sell futures in October and then make our cash sale in May. So what you can see, the gray bars here, the on-hedge strategy, we see large positive returns a lot more frequently on the soybean side than we do on the corn side. So you can see, I didn't count them up, but there's probably almost 10 or so years in the last 30 years where we've had returns, net returns, again, this includes costs, over $1 a bushel, which are pretty phenomenal. You can look at 21 being this last year, futures rallied from $10 a bushel, or excuse me, prices rallied from $10 a bushel at harvest to over $15 in May. So that $5, 478 there were huge returns to that strategy. The hedge strategy for soybeans doesn't look quite as good as what it did for soybeans. Again, there's a number of reasons why that is, which I don't have time to get into, but you can see that, again, it's a little more of a steady strategy, but maybe has some downside risk there on years where we don't get basis appreciating as steadily as it does for corn. And so on average, that storage hedge strategy for soybeans in this particular scenario gave us a 5-cent per bushel return, net return. The on-hedge strategy, though, much higher at 75 cents per bushel. So really what you're looking at here is the frequency of those returns and the average of those returns. And so, corn versus soybeans, corn has some big home run years, but when we throw those out, that hedge strategy looks pretty good. Soybeans, on the other hand, much more frequently we would want to see positive returns associated with an on-hedge strategy. Maybe that's something we want to have as part of the portfolio.
The other thing I noticed looking at those two charts, Nathan, is when you look at the hedge strategy for corn, there's only 1 year where the hedge strategy produced a negative return.
Right.
That's not true in soybeans.
That's right.
So clearly a distinction there in terms of what you want to do with respect to storage hedging. Looks much more favorable for corn than it does for soybeans. Unhedged storage looks much more favorable for soybeans versus corn when you're thinking about it from a long-term standpoint. In other words, thinking about a marketing strategy or approach you want to take kind of year after year after year, right?
That's right. So then I want to wrap up with kind of a final discussion that maybe builds on some of what we've talked about so far, and that is thinking about carrying charges and the seasonality of futures markets. So what we're looking at here is the difference. So carrying charges is just the difference in futures contracts, right? So here we're looking at the difference in December futures and the following July futures. So the spread between those two contracts. And we're looking at it from the first week of January prior to harvest. So this is a pre-harvest period up through the expiration of that new crop December corn futures contract. So this is kind of everything happening up to the expiration of, let's just say, for example, this year, the December 21 contract. So we're starting in January 21, looking at that spread through December of 21. And again, this is a 30-year average. So I've taken how that spread has changed throughout the year for 30 years and looked at what the trend is. And so what you can see is typically at the beginning of the year, there's much less of a premium between those two contracts. So the December and the following July futures are much closer to each other at the beginning of the year. And as we get closer and closer to the expiration of that December contract, that spread between those two contracts starts to widen. And that's a pretty consistent pattern that we see in the data. And so it raises a question of, well, okay, when should we be doing our hedging from a futures perspective? The problem with that is, okay, well, that's nice to know that, Nathan, that's a good pattern. Does that mean that I should do all of my hedging later in the year to lock in, higher carrying charges? So if you advance just another slide, we have to throw that up against what we know about the seasonality in futures markets. That is how futures prices change throughout the year. So over that same time period, so again, starting January prior to harvest through expiration of that December contract, I'm looking at a futures price index. Okay, so this is for December new crop corn futures. And I'm looking at it on an index basis just to kind of normalize price levels from year to year, given that the data goes back quite a bit. So the index just says, in January, the first week of January, the index is 100. Anything above 100 means that prices tend to increase that time of year. Anything below 100 would mean that prices tend to decrease relative to the first week of January that time of year. So what you can see is we typically see futures prices have strength in those kind of early summer months, May, June, July. So that peak at 104, that would be futures prices in June are 4% higher on average than what they are the first week of January. And then they tend to revert to their kind of seasonal lows at and around harvest. That 95 would mean that it's 5% below the futures price the first week of January. And so again, we have some basic structure here. The problem is implementing a strategy around this we have kind of an inverse relationship. When futures are seasonally high, we don't have the widest carry in the market. Okay, but when the carry is widest at around harvest, futures tend to be low. So how can we develop a strategy that allows us to take advantage of both of those things? And fortunately, the markets allow us to do that. And if you've heard of anybody talk about hedging and rolling, so that would be the strategy that will allow us to hedge. So in the summer, when futures prices tend to be seasonally high, we would sell new crop December corn futures. That wouldn't lock in the spread between December and whatever more deferred contract month you were looking at. Here, I'm just looking at July. You wouldn't lock in that spread yet, right? You would just be locking in the futures price when it's seasonally high. You would carry that position through. Again, based on what we're seeing here, those spreads tend to be widest, really in that month or so before the contract expires. At that point, right, you would buy back the December contract and immediately sell the July contract, which would lock in that spread on the screen there, that 22 cents. And then you would have both achieved a favorable seasonal average of the futures price, as well as the widest spread based on the seasonal pattern. And so that would be kind of the strategy that you would want to use that would allow you to take advantage of what we know about kind of patterns in both the carry in the futures market, as well as the seasonality in the futures prices.
You know, Nathan, when I look at that chart, I'm reminded a couple of years ago at our Top Farmer Conference, we had a speaker from Iowa State, Chad Hart, and he talked about timing your corn sales. And one of the comments he made was, year in and year out, selling corn either just before or just after Father's Day is a pretty good strategy. And that matches up perfectly with your analysis, right? That's about where that 104 is. That's right around Father's Day. Doesn't happen every single year, but over the course of your career, that's a pretty good time frame to be thinking about selling some new crop corn, right?
That's right. So then if we compare this kind of hedge and roll strategy, where again, we're taking advantage of the information that I'm showing you on this chart, we can compare that with the previous two strategies, which was unhedged, right? So we're just speculating on storage returns, and then the basic storage hedge, what I called the basic storage hedge, where we're hedging once we have the crop in the bin. So on the next slide, we can look at the average returns. Again, these haven't changed for the first two strategies, the 33 cents and the 17 cents a bushel. That's exactly what I showed you a few slides ago. When we look at that hedge and roll strategy and how if we just implemented that every year over the last 30 years, on average, that would generate a net return. So again, a return above storage cost of 36 cents a bushel. So a little bit better than what we saw from that on-hedge strategy. But again, remember that on-hedge strategy had 4 years or so that were really driving that average. And when we took those out, those home run years, that average dropped quite a bit. And so it's a steadier strategy, less risky, and it generates a higher return. The other thing people want to think about sometimes is, okay, well, you're showing me these averages and then you're showing me the distributions, and there's a lot of risk that underlies those, and that, that makes me nervous. I don't trust averages anymore. I want to see the distribution. So you can think about it in terms of frequency. So I just want to know, how often is this hedge and roll strategy better than the other two that you showed me? So if you just look in any individual year, which of the three strategies was best, right? So over the last 30 years, that hedge and roll strategy was the best strategy in that year, 17 out of 30 years, 7 out of the last 10, and then 4 out of the last 5. So you can see from a probabilistic standpoint, that's really the strategy that gives us the most consistency in terms of producing positive, as well as most frequently producing positive returns. So then quickly, I'll just show the same sort of thing for soybeans. I won't dwell on it because it's the same information. Their timing is slightly different, but again, this is just the carry in the futures market, same time frame. We're looking at January prior to harvest up through the end of October, when the November November new crop soybean contract would go off the board. And again, you can see that spread tends to be narrower earlier in the year, and then as we approach expiration, tends to get a little wider, which would mean we would want to lock in that spread later in the year, closer to expiration. But on the next slide, we have the seasonality in futures. And again, we see this inverse relationship. When new crop November soybeans tend to reach their peaks in terms of seasonality, highest prices seasonally, that's not when those spreads are widest. When the spreads are widest, that's when we see the lowest soybean prices from a futures perspective. So again, implementing this hedge and roll strategy would allow us to take advantage of both of those two things at the same time. So looking at those returns, again, the unhedged and basic storage hedge 75 cents per bushel and the 5 cent per bushel are the same as what we saw a few slides ago. You can see this hedge and roll strategy maybe is not quite as high of an expected return. That 38 cents per bushel is still only about half of the 75 cent on the on-hedge strategy, which again produces very consistent and very high returns, but again has downside risk, and that's what we have to pay attention to. Again, looking at it from a frequency perspective, that hedge and roll strategy, as opposed to corn on soybeans, is only the best strategy 12 of the last 30 years, 3 of the last 10, and 2 of the last 5. So less frequently is that the best route. And so really what we've been selling, so you take all this, right? You're like, Nathan, you've put a lot of information in front of me. Just tell me what I should do, right? Really the takeaway that I have when I go around and present this information is pushing a marketing portfolio strategy, right? So not only should you be spreading out sales over time, that's something that a lot of people do. It's obvious. You don't make all your sales on one day because prices can go up or down, but spreading that risk across different strategies. Because again, you can see from this, there is no silver bullet. So using multiple strategies and allocating what proportion of the crop you want to devote to each of those strategies is really a personal decision, depends on your risk preferences, your risk tolerance, but each of them have pros and cons. And so allocating, yeah, you know, that unhedged soybeans, those look really good. I want to have some of my bushels allocated that way. That's fine. But as Michael indicated, there's downside risk, and that's not something we want to do with all of our bushels. So what percentage of the crop we're going to allocate to the on-hedge strategy versus a hedge strategy versus doing some pre-harvest marketing, right, and filling all of those things in.
And just as kind of a little preview, I think some of the ongoing research that you and Dr. Langemeier are working on, along with one of your graduate students, is trying to identify that optimal portfolio strategy, right? So you've got some quantitative work going on in the background, not quite ready to talk about it yet, but hopefully in a year or so, maybe we'll have some better results that maybe fine tune that strategy just a little bit.
Yeah.
So Michael, let's turn to you. And you've been, you're kind of the man of the hour because everybody's trying to figure out, can we make any money at these prices and at these costs? And what's happening to things like cash rent?
I don't know if I have the answers, but we're certainly going to look at some charts and talk about this issue. If we move to the first slide here, first of all, according to the Purdue Ag Econ report, the latest Purdue cash rent and land value survey, cash rents were up about 5% in 21, and land values were up close to 15%. So land values were triple cash rent. What about cash rents for 22? Well, I've got a guesstimate here. I've got a guesstimate of 5%. It could easily be 5 to 10%. Obviously, we won't know those numbers until the next summer when we do the survey. So that's what I want to talk about in this slide. I think we can learn a lot about where cash rent may be heading in 22 and years after that by looking at long run averages. So what I've done is I've compared the net return to land to cash rent from 2007, start of the ethanol boom, all the way to a 22 projection. And what you can see here is it takes several years of high income from the operator's standpoint to drive those cash rents up rapidly. In fact, you know, after 7 to 10, we had some good returns. Cash rents increased more than 10% in 11, 12, and 13. Are we in a similar situation right now? I don't think so, because even though the net return to land was very strong in 2020, a large part of that was government payments, but very strong income in 21, good prices with lower input costs. The input cost increases hadn't hit the 21 returns, and so a very good return in 21. 22 doesn't look near as good. And so yes, there's upward pressure, but I don't think we're going to see a situation where we're going to see 2 or 3 years in a row of double-digit increases in cash rent. Going to the next slide, let's look at net farm income per acre. And so this chart just puts in perspective how good 21 really is. Obviously this is not finalized. We still got a little bit of time to go here for 21, but this is going to be pretty close the way it's going to end up. 21 rivaled some of those earlier years during that 2007 to 2013 period. But the difference here, again, from a cash rent standpoint, is 20 was good, but it wasn't quite as good as some of those other years from 2007 to 2013, and 22 does not look as good as 20 or 21. I update this slide monthly in the webinars, and Jim and Nathan can attest to the fact that every time I update this, 22 bar comes down a little bit. Why? Input costs keep increasing. And so as those input costs increase, unless prices increase with that, 22 doesn't look quite as good. Does that mean 22 is going to be a train wreck? No, not necessarily. 22 is just going to be closer to break even than what we saw in 20 and 21. So we move to the next slide here. This is showing some of that cost impact. We're seeing cost increases in fertilizer, pesticide, and seed. Seed is much more modest than the expected increases in herbicide, and herbicide and seed are much more modest than what we're seeing in fertilizer. This is using current fertilizer prices, and so, for example, anhydrous ammonia in this chart is at $14.35. That's the latest information from the Illinois production report from the USDA. But fertilizers, 80% higher. Fertilizer costs are 80% higher on corn compared to last March. And so just a very large increase there. Obviously, that's increasing the break even and making the margins much tighter in 22 than what they were in 2020 and 2021. And so even though prices are really strong, you look at prices in November soybeans, November 22 soybeans and December 22 corn. Those are good prices compared to the averages we've seen since 2007. These break-even prices are also really high compared to break-even prices since 2007 and really historically.
Michael, when I look at that chart, one of the things that jumped out at me when I was looking at these yesterday is the fact that when you look at 2022, that's the only year on there where the fertilizer cost per bushel is higher than the cash rent cost per bushel.
Yes, that as far as I know, I've been doing this a long time, Jim. I've been looking at cost of production since 1990. This is really unusual. I don't even remember a year where it's even close to being the same. Yet a year where it's actually identical or slightly higher. And let me talk a little bit about the importance of cash rent, because I'm going to talk about flex rent here in a little bit. Year in and year out, if you look at long run averages, cash rent tends to be the highest cost. For corn, it averages about 30% of total cost, whereas soybeans, it's closer to 40%, because soybeans, you don't have the high nitrogen cost. And so it's really rare to see fertilizer cost similar. In this case, 27% of the expected total cost for corn in 2022 is fertilizer alone.
Yep.
If we look at the next chart, this is looking at the N rate calculator tool that's based out of Iowa State, but the data is collected from agronomists across the Corn Belt. And so this is based on Purdue agronomy information. And what this shows you is as we get to these really high fertilizer prices, right now we're about 87 cents for anhydrous ammonia. But as we get to 80 cents and $1, notice what happens to the optimal N rate. The optimal N rate does come down 20 pounds, 25 pounds, 30 pounds from what we put on when we had 40-cent nitrogen. 40-cent nitrogen, it was actually similar to what we had last spring. And so, when you have 40-cent nitrogen, you're going to put on that 192 pounds. You're going to put on quite a bit of nitrogen. As the price gets larger, you're probably going to put on less. And so keep this in mind. I encourage you to go to that website for N-rate calculator and calculate for your part of Indiana, or from Illinois, your part of Illinois. And so we've got this for several Corn Belt states, because I think this is very important to keep in mind. We don't need that 192 pounds of nitrogen to get close to that 100% of that yield. Here we're dropping nitrogen quite a bit and only losing 2% of the yield. And why are we willing to give up 2% of the yield? Well, I think it's obvious that cost just accelerates as you start putting on that 190 to 200 to 210 pounds of nitrogen. So take a look at that website. What about break-even prices? I update this chart every month too for our webinars, and these bars also increasing. These red bars are also increasing. My latest estimates looks at even on high productivity soil. This is soil with 215 bushel corn and 65 bushel soybeans. We're looking at a break-even price for corn that's $5. I don't remember talking about a $5 break-even price, but that's where we're at on high productivity. If we look at 182 bushel corn, which is the average productivity, that's the trend for Indiana, 182 bushel corn. Obviously, it'd be higher in this part of the state, but that's the average for the state. We're looking at break-even prices of 540. As we get to that more marginal ground, not that Indiana has a lot of marginal ground, but as we get that lower productivity ground, the break-even approaches 590. And so I think we can use this chart to think about what's probably going to happen to corn acreage across the Corn Belt. I'm going to talk a little bit more about corn versus soybeans here in a little bit, but I think we can use this chart here to start thinking about national acreage. The speaker before was indicating that he expected some reduction in corn acreage as we move to further west into that North Dakota, South Dakota, and Kansas. Those states grow a lot of corn and a lot of dryland corn. Even in Kansas, there's non-irrigated corn all the way in the western part of Kansas and Nebraska for that matter. And so we're growing corn in places we didn't think about growing corn 20 years ago. In those parts of the country, you're probably going to see some reduction in corn acreage. The costs just aren't warranted to grow corn on some of those acres. And so if we see some slippage in corn acres, that's what's going to happen. And that's why I wanted to talk about this, because I think this slide shows that. As you get in that lower productivity soil, soybeans are much more competitive compared to corn, as well as other crops like spring wheat in North and South Dakota. So moving on to the next slide, this shows that for Indiana, shows that relationship between corn versus soybean profitability. And what this clearly shows to me is it's somewhat surprising to me is how competitive corn really is this year, despite the fact that we took the break-even price from $4 to close to $5. So despite that, the very high cost for corn as well as soybeans, but more so for corn, corn is still very competitive on that average to above average soil. And so the last 5 years or so, we've been running maybe 5% more soybeans than corn acres in Indiana. I think that's going to be much closer to 50-50 based on this analysis this year and doing this for 10 years. I really think corn's going to hang right in there in Indiana and across the Corn Belt. And be very competitive with soybeans. And again, surprisingly, because of the high input costs, that corn's going to stay in there. And I also think, talking a little bit about what Jim was talking about and the speakers before us, I think there's quite a bit of downside risk with soybeans. And so I think you need to keep that in mind when you're looking at a chart like this. Not that there isn't for corn, but there's some factors that could take that soybean price below the $12 mark. Certainly into the fall. And so keep some of these things in mind when you're making some of the decisions on some of your marginal acres. I know many of you use the rotation corn, rotation soybeans routinely, and so not going to migrate away from that. But I think we'll see a little less second-year soybeans this year. How about continuous corn? Not in Indiana. When I look at I look at a similar chart, table like this for continuous corn, it just doesn't look competitive with rotation soybeans. That's not uncommon for Indiana. We tend to grow 50-50 in Indiana. As you move further west into Iowa, for example, they typically have a corn to soybean acreage ratio of 1.45. If anything, I think that might increase a little bit. Because in Iowa, corn is always more competitive than soybeans, given every, in a typical year. And so I think we'll see quite a bit of continuous corn in Iowa, but not necessarily in Indiana. So that's my take in terms of the acreage in Indiana and across the Corn Belt and nationally. We go on to the next slide. Now I want to talk just a couple minutes about flex rent. I've been getting a lot of questions on flex rent. There's a lot of different flex rent examples out there, so this is just one of them. With this particular example, it's flexing on revenue. I always recommend flexing on revenue, both price and yield, rather than just price, just yield. That way, if there's a really high corn yield, very high soybean yield, the landlord perhaps gets a bonus that year. Also, if we see a price spike in corn or soybeans this fall, they would receive a bonus. And so I like to flex on both of those. What this one does is it sets the base rate at 90%. There's usually a floor to this flex rent. And then it flexes if the gross revenue is above non-land cost plus base rent. That's a pretty high hurdle. I've seen hurdles for other flex rents that weren't near that high, because you think about that, this is full costing. This is with opportunity cost in there. And so if you own your land, we've got to charge for that. If you own your machinery, we've got to charge for that. And so that's a pretty big hurdle. for the revenue to jump over. But there is years where this obviously happens. And again, if there's a really good yields next fall, or very good prices, or both, the landlord would receive an increase in their rent. This is certainly less risky than increasing that rent substantially in 22. Might be too late. You might have already done that, but increasing your rent substantially in 22, then having to negotiate a lower rent in 23. So that's why they're getting a lot of flex rent questions this year, and probably will continue because of all the uncertainty related to prices. These flex rent arrangements work really well in that environment. So let's see what happens in this kind of arrangement. And so this is actually looking at share minus fixed, and so I've thrown share lease in here, and so 0 would be same return for both of those. Obviously, when you see good yields, good prices, share rent does well.
So, Michael, your share rent is a 50-50?
50-50 in this case, though a 1/3, 2/3 would be very similar. 1/3, 2/3 where the landlord pays no cost. That would be very similar to this graph. And so 7-13, share rent was better than fixed. The last 2 or 3 years, share rent was better than fixed. Let's go ahead one slide, and we'll see the flex rent. The flex rent has some of the same features as a share rent. That's what makes it attractive to the landlord and attractive to the operator, because you're reducing that base rent by 10%. And so there's a lot of years where the base rent is lower than the market rent. But it does give you that upside potential from a landlord perspective in the really good years. And so you see from 7-13, there was higher returns for the flex rent than there was for the cash rent, very similar to the share rent. But notice a big difference in that graph between the flexible rent and the share rent. The share rent doesn't really have a bottom. When you're sharing 1/3, 2/3, or 50-50, there's no bottom. Whereas the flex rent, the bottom is the base rent. And so that rent can only go to 90% of the market. It can't go any lower than that, the way they've set this up. And so I'd like to talk about downside risk. Jim and Nathan know that, because I'm kind of a downside risk person. I'm very risk averse, and so I love that subject. The flex rent has a lot less downside risk compared to the crop share. And so I think it's a very attractive option. It's kind of in between that share rent and that cash rent. But if the landlord wants some upside potential, I think the flex rent fits in quite nicely with that. I've got one more slide here looking at 22. What about 22? Well, 20 and 21 were really good years for flex rent because we had strong prices and strong revenues. 22, not so much. And so if you're thinking 22, I'm going to start flex rent, I'm going to hit a home run, you might. But you might also hit a single or hit a little grounder to the pitcher, if you will. I like baseball, so I use the baseball analogies. And so using current projections, $5.20 corn and $12 soybeans, trend yields, and a fixed cash rent of $275. This is average productivity in west central Indiana. Under the flex rent, we'd have a small bonus, but remember, we're only paying 90% of the base. And so if that bonus is small, we might not get up to the market cash rent. And in fact, we don't. The flex rent's projected to be about $30 per acre lower than the market cash rent. And you can say, well, why would I want to do this? Well, there is some upside potential for both corn and soybeans. And so it doesn't mean the flex rent necessarily going to be bad. It's just that if you look at the averages right now, it's not necessarily going to be better. I did calculate the prices needed for flex rent to equal cash rent. They're not outside the realm of possibility by any means. $5.54 corn and $12.78 soybeans. And so I just wanted to show you kind of some historical analysis related to the flex rent. It does have its place, I think, in the Corn Belt in particular, and also show you some projections for 22.
So with that, I think that kind of wraps things up for us. We've got our Top Farmer Conference coming up here in early January. If you haven't participated in the Top Farmer Conference, we've been doing that at Purdue for over 50 years. The last year and this year, it's been virtual, so it's on Zoom, so you can access it from anywhere. I've got some cards here with some details on the agenda, but I'd encourage you to tap into that. It's a great conference. We're going to do it on Zoom, so it'll be a couple hours in the morning, a couple hours in the afternoon with a lunch break. And then as Michael's indicated, and Nathan I think has indicated as well, we do these webinars every month that you can tap into what's taking place with respect to the outlook. And we always do them typically the day after the USDA releases its World Ag Supply Demand Estimate. So it's a good way to kind of get the update on what USDA's got to say, as well as our interpretation of it. So with that, I'm going to turn it back to Andy.
Quick word on the Ag Economy Barometer earlier this month. Did you touch on that?
We did not.
You did not. It went down. Surprise, surprise.
Yeah, surprise, surprise. So the barometer has been down, I think, every month now for about the last 5 or 6 months, except one. And, you know, you can see why when you look at this tremendous increase in input cost that's clearly weighing on producers' minds. There's also some concerns showing with respect to just the uncertainty about the total economic environment. People are concerned about the regulatory environment. They're concerned about environmental policy. They're concerned a little bit about ag policy. They're definitely concerned about tax policy. They might be either happy or unhappy, depending on how that shakes out this week in Washington, right? So a lot of uncertainty out there, and that has really fed back into the barometer with that sentiment index really quite a bit weaker. We were basically at all-time highs back in the spring, and we've been going down ever since. And then as you look, maybe the underlying thing that's probably interesting is in the face of that weakness in overall sentiment, how optimistic people continue to be about farmland values. Both our long-term and short-term farmland value indexes are at very, very close to record highs and have been for some time now. So people are optimistic about where farmland values are going. That's very consistent with what we see with all the auction reports. But at the same time, there's this tremendous amount of uncertainty hanging over them, and that is weighing on their minds with respect to sentiment.
Certainly. Thank you so much for being here. Jim Mintert is the director of the Center for Commercial Agriculture at Purdue. Also, Dr. Michael Langemeier, Dr. Nathan Thompson here with us today. We appreciate all of the data, and we'll look forward to updates next month, as you said, as well. Thank you for joining us here at the Indiana Farm Equipment and Technology Expo. A quick break, and then Jason Powers with Unbridled Wealth. We'll have some interesting information to share with you next. We'll be back at Grand Park in Westfield, Indiana.
Thank you. You want me to stay for that?